Hello everyone, today I want to talk about what rising interest rates mean for your mortgage, specifically your monthly or annual mortgage repayments. Now, at the time I'm recording this video, there's lots of talk about interest rates. The European Central Bank has just increased interest rates in the Eurozone to the highest level in a decade. Central banks in the US and the UK are also increasing interest rates, and it's just a pretty crazy time for the global economy. So I thought it would be helpful to illustrate how changes in interest rates could impact your mortgage repayments. And as you'll see, a seemingly small change in interest rates by just 1 or 2% can have a massive impact on how much money you end up forking over to the bank. So let's kick things off with an example. We're going to assume that we have a nice round mortgage of €400,000 and that we're paying this mortgage off over 30 years. And to begin with, we're going to set the interest rate at 3%. Now, what we're going to do is compare how much this mortgage will cost us at an interest rate of 3% with how much it would cost us at 4% and even 5%. So you can see here on the mortgage calculator that a €400,000 mortgage repaid over 30 years at 3% comes out to a monthly repayment of €1,686.42. FYI, I will be doing a follow-up video showing you how to build this mortgage calculator for yourself on Google Sheets. If it's already uploaded, it will be popping up on screen now for you to check out after this video. So €1,686.42 is how much we'll be paying the bank each and every month for 30 years to repay this mortgage. That figure of €1,686.42 is made up of two components, an interest component and a principal component. The principal component goes towards paying off the €400,000 which we borrowed from the bank. The interest component is the additional money we're paying the bank over and above the €400,000 we borrowed. Over time, the balance between how much of our monthly payment is interest and how much is principal changes. To illustrate this, I've isolated the first 12 months and the last 12 months of mortgage repayments on our calculator. As you can see, the monthly payment to the bank is the same, from the first month all the way to the last month in December 2052. In January 2023, which is the first month of the mortgage, €1,000 is paid to the bank as interest. That's simply calculated as our beginning balance of €400,000 multiplied by the interest rate of 3%, which gives us yearly interest of €12,000, and divided by 12 to get the monthly interest figure for January. But remember, our formula told us that €1,686.42 is the total monthly repayment. So therefore, the difference between that number and the €1,000 paid as interest is the principal component of the payment. In this case, that comes out to €686.42. Even though we've paid the bank €1,686.42 in January 2023, our mortgage balance at the end of the month has only gone down to €399,313.58. That's because only €686.42 of that payment went towards paying off the balance. So in the next month, the mortgage balance of €399,313.58 will be used to work out the interest component, again by multiplying by 3% and dividing by 12. As you can see, the interest component has gotten slightly smaller and the principal component has gotten slightly larger, and over time more and more of your monthly payment will go towards paying off the mortgage balance and less will go towards paying interest, to the point that by December 2052, when we make our last payment, only €4.21 is going towards interest and €1,682.21 is going towards principal. Long story short, in the early years of your mortgage, the majority of your monthly payment is made up of interest, which nobody likes, and in the later years of your mortgage, the majority of your monthly payment is made up of principal, which we like. But again, how much you actually pay each month on a total basis never changes, provided the interest rate doesn't change. So this mortgage will end up costing us €20,236.99 each year, and over 30 years, we'll make total repayments of €607,109.81. Given that we originally borrowed €400,000, that means we've paid an additional €207,109.81 as interest over the course of 30 years. A pretty sickening number to think about, but that's just the reality of having a mortgage. Now let's take a look at what happens if we increase our mortgage interest rate by just 1% from 3% to 4%. Our monthly payment has increased to €1,909.66, which is an increase of over 13%. That's €223.24 extra towards mortgage repayments each month. That's the the impact a seemingly small percentage like 1% can have on your monthly mortgage repayments. This works out to €22,915.93 in yearly repayments, and over 30 years will make total repayments of €687,478.03. That means we're paying €287,478.03 worth of interest, which is a whopping 38.8% more interest than our previous example. What about an interest rate of 5%? At a 5% interest rate, our monthly payment goes up to €2,147.29. So we're paying €460.87 more per month than we were at an interest rate of 3%. That's an increase of 27%. Insane. This comes out to €25,767.44 in yearly repayments, and over 30 years we'll make total repayments of €773,023.14. That's €373,023.14 worth of interest, which is nearly the same as the amount of money we borrowed in the first place. That's also 80% more interest than what we paid under the 3% mortgage. Incredible. In fact, if we increase the interest rate to 5.31%, we officially pay more interest than what we borrowed in the first place. That would mean total repayments of over €800,000 on a mortgage of €400,000. So as you can see, small percentage increases are no joke. I also want to highlight the differences between the ratio of interest versus principal at different interest rates. At a 3% interest rate, 59% of our payment in month 1 is going towards interest and 41% is going towards principal. At a 4% interest rate, that increases to 70% towards interest and 30% towards principal in month 1. And at a 5% interest rate, 78% of our payment is going towards interest and 22% is going towards principal in month 1. Point being, the higher your interest rate, the more interest you end up paying relative to principal in the earlier years of your mortgage. That's why the difference between how much interest we pay over the life of the mortgage at different interest rates is so significant, because the principal is reducing at a slower rate, which gives the bank a larger outstanding balance to charge the higher interest rate on. So now that we understand how mortgage repayments work and we understand the effect that higher interest rates have on our mortgage repayments, let's talk a bit more about how your mortgage is affected when the central bank increases interest rates. In each of the examples we went through, the interest rate was the same for the entire period, i.e. it was either 3%, 4% or 5% for 30 years. That would only be the case if you had a 30-year fixed rate mortgage, i.e. the rate is fixed at the outset and doesn't change for the duration of the fixed period. Many of you will likely have a fixed rate period on your mortgage that is, say, 5 or 10 years in duration, after which you'll either move onto a variable rate or you'll move onto a new fixed rate. Variable rate mortgages do what they say on the tin. The interest rate on the mortgage varies over time. These are the mortgages which have the potential to be impacted by changes in central bank interest rates. When the likes of the European Central Bank increases interest rates, the bank with whom you have your variable rate mortgage has to make a decision as to how much of the increase in interest rates it will pass on to you, the mortgage holder. If the central bank increases interest rates by 0.5% and you're on a variable rate mortgage, that doesn't necessarily mean your mortgage interest rate will also increase by 0.5%. It's at the bank's discretion to decide how much of that increase it will charge you. If you're on a fixed rate mortgage, you never have to worry about your rate increasing until the end of the fixed rate period. The only people who are guaranteed to be instantaneously impacted by changes in the central bank's interest rates are those who have what's known as a tracker rate mortgage. A tracker rate mortgage, again, does what it says on the tin. The interest rate on the mortgage tracks another rate. That other rate is typically the interest rate set by the European Central Bank, or the Bank of England if you're from the UK, or the US Federal Reserve if you're from the States. So for example, your mortgage interest rate might equal the European Central Bank rate, which at the time of recording this video is 1.25%, plus another 1% on top of that, so 2.25% in total. Anytime the European Central Bank rate increases or decreases, your mortgage rate will also increase or decrease by the same amount. These mortgages are very attractive in times where central banks are stimulating the economy by keeping interest rates low, but they can also be unfavorable in times when inflation is high and central banks are trying to tighten the money supply by increasing interest rates. Ultimately, the extent to which your mortgage repayments are affected by changes in central bank interest rates is going to depend on the type of mortgage you have and the bank with whom you have it. As we illustrated earlier, a change in mortgage interest rate of just 1% can have a massive impact on your repayments. So make sure you're keeping up to date with any correspondence your bank sends you with regards to your mortgage interest rate. Remember, it could also be worthwhile reviewing your current mortgage to see whether better deals exist elsewhere on the market. So that's how rising interest rates affect your mortgage repayments, and as we've shown, just a small increase can make a massive difference. Now that you're more aware about your mortgage, it's time to become more aware about your investments. Inflation is at multi-decade highs, and if left unchecked, your money could be worth significantly less in the future than it is today. If you want to know what 3 investments I'm currently making to prevent this from happening, check out the video popping up on the left hand side of the screen now. If you want to learn how to build the mortgage calculator which I used in this video for yourself, the full tutorial will be popping up on the right hand side of the screen once it's uploaded. Don't miss out on either of those videos, and I'll see you soon.